So today we're going to talk about tax analytics in ProjectionLab. Once you've created a plan and gotten comfortable with the Plan tab, you may find yourself needing a deeper understanding of the taxes and how they affect your plan. To do that, we can use tax analytics. So tax analytics is broken up into two major sections. The top half, which gives you sort of the bird's eye view of your income and taxes over the life of the whole plan, and then the bottom section, which is more of the deep dive into a specific year in the plan, whichever year you've selected up here. Before we look at the deep dive, let's go ahead and take a look at the bird's eye view. So on the income section, you're going to see your various income sources over the life of the plan, and these are all color-coded here and correspond to this legend on the side. And by default, effective tax rate is disabled, but you can enable that if you want to see sort of that effective tax rate overlay, and then that of course, is going to introduce a second y-axis here, and you can kind of see how the effective tax rate changes over time. For simplicity, we'll probably keep this off most of the time, but we'll come back to effective tax rate later. So in particular, we can see many different things here. If you've watched the Roth conversion video, this is the same plan, and in this case, our couple is planning to retire early, so they have all of this wage income. So that those are the green colored income items here displayed, and those are corresponding down to this legend as well. So if you wanted to, for example, you could disable those, and so you can hide and show income sources by clicking them on and off here. And then further through the plan, in the middle section, we're relying here on mostly long-term capital gains. So you can see that here as well, showing up here in the legend. And then we also highlight penalized distributions as its own income type, and so on and so forth. We see taxable distributions here in purple. And these are going to be withdrawals from 401k, for example, or pre-tax 401k or traditional IRA. And then further, these lighter green, sort of lime green colors are the correspond to the case of the taxable Social Security and tax-free Social Security in that slightly darker green, and so forth. You see here in later in life, the bulk of the income coming from RMDs. So those are highlighted in their own color. So these would be basically the same type of income that a taxable distribution would be, but we highlight them here in sort of this pink. Red color to distinguish them from optional or sort of non-mandatory distributions that are happening here earlier in the plan. So that's pretty much it for income, at least at a high level. So now we can kind of take a look at the taxes tab and see how taxes vary over time. So you're going to see a pretty similar shape to the tax graph, but the composition is different, and we can sort of see here at a high level what the source of the taxes are and in the magnitude of them. Another helpful thing here, similarly, we have the legend here color coding the different types of taxes being paid. And you can also click the aggregate button to deaggregate and then show you sort of more detail as to exactly how these items are being taxed. So in this case, we can, if we want to dive into sort of one of the earlier years when our couple is still working, we can see here lots of detail: property taxes, state, local, state. Long-term capital gains, state income tax, etc. Even breaks out Medicare, Social Security, and then of course the largest component here being the federal income tax. Whereas sort of in this middle section here, you can see how early withdrawal penalties are being sort of highlighted here as a form of tax in particular. There's his property tax, state income tax, etc. And then kind of in the later in life, we're going to see a few of these additional sources of tax. You have Medicare premiums that are being modeled on here as a tax, and actually, if we go further down, we can see some additional items here. We'll see the IRMA surcharge for high earners, as well as Medicare. And IRMA, if you're not familiar with it, is a surcharge that high earners pay on their Medicare premiums. You'll also note that when we deaggregate, that we automatically display more metrics here. So this is showing you the breakout of the IRMA charges and the Medicare charges per person. And just to get a slightly less detailed view, we'll switch back to show these as aggregate. Now, if you like to see marginal tax rates or effective tax rates over the life of the plan, this can be these next two views can be helpful. So in this case, we have marginal rates. So this would be effectively saying the tax rate that you are paying on the last dollar of each income type in a given year. So you can see how these lines change over time, and we introduce again the same color coding here that you're familiar with from the previous two pages, versus effective tax rates. So effective being sort of the averaged amount of tax you pay, again by source of income. Finally, we can look at all this data in a tabular form, and this can be helpful if you like to export this to another, or maybe you just like to view it as a table, or you prefer to export it. You can export and save it to some common formats to use the data in whatever tools you prefer. Before we move on to the yearly deep dive, let's look at the chart options and metrics display options. So here in the top right, we have metrics, and we can select from a very long list of additional things we might want to show. Say we want to show our local taxes. So this would just be a way to kind of see the plan total. And as you're hovering over a given year, the metrics up top will be showing you the amount for that year. Let's just look at one last piece, the effective tax rate. This is a common request and question around this. So by default, the average effective tax rate includes local taxes. So this would be your property taxes. If you wanted to change how this works, and let's just go ahead and turn on effective tax rate so that we have that overlay here. You see, you see some odd things here, perhaps. So in this year, for example, there's a large spike in effective tax rate, and this is simply because all of the income here is tax-free distributions, which, again, based on the settings, don't count as income. We can show how to modify that, and since in this case our couple is paying a fair amount of local taxes, this causes the effective tax rate to be skewed. And if you would like to change how this works, you can go into the calculation settings. This little gear shows up. So this is a special settings section that only appears on this metric. And you can go in here and deselect local tax, for example, and that'll give you a much smoother line, and probably more, in some cases, maybe closer to what you would expect. If you wanted to as well, for example, if we reselect this year that did have that spike, it's now down to 9.98%. Because we've excluded local taxes. You may also want to decide to count tax-free distributions as income. And if you did that, then it would drive the effective tax rate much, much lower by essentially inflating what's included as income. So yeah, you have many options here. So for our purposes, we'll go ahead and unselect that, and we'll leave the local taxes off. And then on chart options, similar to what you have on the plan, you can change, the size of the graph if you like. You can change what icons are displayed. So by default, you'll see all. You can make it none or milestones only. One last piece that might be useful is using the year as opposed to age, if that's how you prefer to visualize it. Okay, so let's dive into the year-by-year tax analysis. So we're going to select here age 59. So this is just before our couple turns 59 and a half. So this is the last year that they'll potentially have to pay early withdrawal penalties. So we select that year here and then scroll down. We see here that ProjectionLab is selected just by the order of the order the accounts were defined to withdraw from Ashley's account. In this case, we see most of the income here being a small amount of savings income over here, so almost a negligible amount, and then over here we have the 10% penalty being assessed here even at the bottom rung. So normally you'd have a certain amount of standard deductions or itemized deductions in order to to fill that sort of 0% tax bracket. So in this case, we were going to be paying 10% on that initial amount, and in this case, they also have a state tax that kicks in at around just under 10,000. So that 1% state tax kicks in, and so on. The brackets are kind of small here, but we see the additional 10% income tax coming in. So that's the bottom federal income bracket, and so on and so forth. The 12% and 2%, all the way up. You can scroll at the top here. We'll see the top rate here being paid, being the 12% federal and 8% state with a 10% penalty on top. So the effective rate here being basically a 30% tax bracket that's being taxed, and then the ordinary income is now sort of stacked on top of that effectively. So the ordinary income being savings income most likely, savings yield here, and that'll be taxed at 20%. And if we want to scroll ahead and take a look at, say, the next year, things look a little different. Obviously, now we're not paying that penalty. Pretty similar amount of 401k withdrawal happening here. So you'll see pretty much the same type of thing, except without that 10% penalty. If we want to pick maybe a more interesting year, we can look at the first RMD year. And by clicking that up in the graph, we now see RMDs, those filling the 0% and slowly growing to include the state taxes and the 12% bracket, etc. And then we also have taxable Social Security showing up here. So this is the portion that, due to the income level of our couple here, they have to pay tax on some Social Security. And if you like to visualize how additional dollars of income would be taxed, you could look at the rate progression chart. So in this case, we see RMDs, additional dollars of RMDs, or in this case, taxable distributions would be the same, would be taxed at 18% up until roughly the next 15,000 in income, and then from about 15,000 to 25,000, you'd be taxed here at 20%. And in this case, it's not visible because it's an overlapping bar. But if you disable the RMDs, you could see where ordinary income lives as well. It's basically the same line. And then lastly, below you have a tabular view of your effective tax rate by income type for the given year. So this is just another way to visualize things. And then you see here the effective tax rate, or the aggregate of that number here under the total. Going back to effective brackets for a second. So here we have the option to aggregate income sources. So in this case, these are showing the RMDs aggregated. If we deselect this, you can then hover over and see the different incomes being split out here. And so in this case, Ashley only has an RMD of 5,000, so that's layered in here at the bottom, and then so the remaining roughly 95,000 is coming out of Jordan's. Another thing you might want to do to give you more room here, you can hide the composition panel if you like. You can also show tax-free sources. So if you wanted to see the tax-free Social Security income, you have that here. Similarly, if you look back to age 56, when we had that large tax-free distribution, that would also appear here as long as we've selected this option. If you deselect this option, then that would hide the tax-free distributions. We'll go ahead and leave those on. Last thing to show you is just a quick tip. If you are, especially if you're working down in this section and you want to quickly move through the years, you can use your keyboard, actually, the left and right arrow, to kind of scroll through and see how things change. And it works similarly, as I mentioned before. If you hover over, the metrics up top will change. Our next topic here is actually not so much about tax analytics, but it's about tax withholding versus the tax estimation that ProjectionLab does. So in our case, we do see a fair amount of confusion around this, and so on that note, we will switch back to plan, and we will look at salary. So salary is commonly used to specify a tax withholding. Salary often represents the only source of tax withholding. So it is important that this is fairly accurate to model reality. So whatever you're actually, whatever taxes are being withheld, you should try to input this number as close as possible. So the key point that we want to explain is that the tax withholding does not alter how ProjectionLab calculates your taxes. It is merely a cash flow activity. So defining a withholding tells ProjectionLab, keep this money on the side, don't allow it to be used in the middle of the year to pay expenses, to contribute to cash flow priorities. And at the end of the year, we're going to settle up the actual tax bill. So the actual tax bill is determined by all of the other inputs of the plan, your income, your deductions, your tax credits if you define those, and what your tax settings say. So your tax settings, so in the case of the U.S. scenario, you're using the estimation features. You would not have to, you can come in here and customize it if you like, but by default, these things are, these defaults often work fairly well for people, but you can, of course, always override. But this is what effectively drives the tax calculation. So aside from the overall plan tax settings, you have a number of ways of defining income. And that's really where the nuance, I think, can be added. So in this case, if you want to add a custom income stream, you'll see something like this. You can specify the income as self-employment, wage income. You can mark it as tax exempt. You can even specify an amount to withhold if necessary. And you can also specify it as dividend income. So to demonstrate how the withholding works versus how ProjectionLab actually estimates your tax bill, let's open up salary here. So let's just create a absurdly large withholding. Let's move this to 80%. And we're going to pick a year while Ashley's still working. So let's go ahead and pick 36 and then click cash flow. We see this large withholding happening, and in the previous year, or at the beginning of the year, we're also seeing this huge tax refund. So these two things are related, right? So this tax refund is from the prior year's withholding, so the excess that was being withheld, versus required to pay the tax bill. So yeah, so we're withholding $100,000. We are getting a refund of about 56. So it looks like we really only owe roughly $46,000 a year. And if we go to plan, again, still selected on the same year, we actually see that exactly. We owe roughly 46,000. So let's just keep this number in mind, 46,408. Now, if we go back and fix the withholding to be a little more reasonable, so we go from 80% to 25% again, we will see a slight change in total taxes owed, but it'll be very minor. So we change this so we see it went up by about $350. And the reason for this is not because the withholding is changing your tax bill directly. This is a compounding effect of having more cash being distributed to cash flow priorities. So effectively, it's the compounding effect of the additional investment that you're getting earlier in your plan. But yeah, so effectively, we see here that the withholding doesn't have a direct effect on how the tax is calculated, but modeling the withholding accurately, minimizing the tax return or the tax payment is a good practice to the extent that you can do it, just to sort of maximize the growth of your investments. Similarly, if we actually just disable this withholding, we would owe again roughly the same amount of taxes. And if we go ahead and look at cash flow, we see here that we have a withholding of only $23,000 happening. That's happening from Jordan's account, but we have a tax payment of $15,000 now showing up as expenses. So just to reiterate, our recommendation is generally to create a withholding that is as close as possible to the real world withholding that you are experiencing. And depending on your situation, you may not have a lot of control over that. So getting the withholding correct such that your typical tax return amount or your payment amount or your refund amount is accurate, or reflects reality, is very can be helpful with projections, just to improve the accuracy, and that it does not matter largely what your withholding is in terms of how ProjectionLab estimates your taxes. The second recommendation is to check that your actual tax bill is reasonably close to the prediction that you see in ProjectionLab. It won't be perfect, but it should be in the ballpark. If it's vastly different, you may need to add some missing income sources or perhaps tax deductions or tax credits to improve the accuracy. But keep in mind that if your income is highly variable or based on largely investment income, which could vary in degree of capital gains versus dividends versus maybe qualified dividends, and in different jurisdictions, I know there's other types of investment income. ProjectionLab may not be able to model all of those nuances currently, so the estimates could carry a higher degree of uncertainty or variance. For those of you who watched the Roth tutorial, this plan will look familiar to you, but just to catch everyone else up, we have our plan here with Ashley and Jordan. The base plan is the scenario where they do not convert any money to Roth. The convert 100% plan is exactly that, where they intend to convert all of the money to Roth prior to RMD age. And then convert 50% is the scenario where they've converted roughly half of their 401k to a Roth. Since this is a tax analytics video, I just wanted to quickly touch on this. And if you didn't watch the Roth conversion video, highly recommend you go and check that out. But for the tax analytics piece, if we look at tax analytics on the 50%, we see some interesting stuff here. We see, again, no early withdrawal penalties. We can see here the portion of taxable versus tax-free Social Security, and this is a large part of why Roth conversion can be so useful. So in this case, converting 50%, still left us with a large amount of taxable Social Security. So if we look at the 100% case, we actually see that actually goes away. So all of the Social Security income, if you convert in this scenario, if we convert all of the money to Roth, that generates a significant gain here for us. So, and then comparing that again to the base plan, again, we have no early withdrawal penalties here. And if we look at the base plan, we have early withdrawal penalties, we have IRMA, we have, again, that same amount of taxable Social Security. We even have some alternative minimum taxes here. These are all the nitty-gritty pieces that contribute to the benefits of doing a Roth conversion, aside from the obvious being the actual tax brackets and smoothing out the actual tax curve on your regular income tax. So I hope this helped. There's a lot in here and probably more to jump into on another video. Please let us know if there's things that you think we missed or that you enjoyed. Also, let us know if there are other topics you'd like us to discuss. We're always looking for feedback. Thank you for watching.